Good morning, everyone, and thank you, FSM, for having me. And to all of you, thank you for spending your Saturdays with us, hearing about investing, hearing about ETFs. So my name is Jordan Lee, an ETF specialist at JP Morgan Asset Management. And essentially, what my role does is that we bring our globally exchange-traded funds across US, Europe, Asia, and to be made available to Malaysian investors like yourself and the broader Southeast Asia region. Now, when we think about 2025, consistent and calm, the year has been anything but consistent and calm. The only thing consistent about trade policies is how inconsistent it has been. And geopolitical tensions have already added an additional layer of anxiety. Now, during such times, investors do need options. Investors need options on how to invest and where to invest. The short answer I'm going to give you is active ETFs. Active ETFs is not just changing the way we invest, but it's also changing investments as a whole. So today I want to talk to you about how active ETFs will change the way we invest, and the same reasons that have driven ETFs as an industry will drive active ETFs to where it is moving forward. I also want to talk about how investors are thinking about active ETFs. How are they using active ETFs in their portfolios? And what are the outcomes that they can achieve? But before all that, let's take a step back and think about 2008, the global financial crisis. One of the most disruptive moments in the financial industry. $7 trillion of wealth was wiped away from the Asian stock exchanges. Malaysia, being a very globally connected economy, its manufacturing and export industry was affected. But ever since the global financial crisis, what has changed since then? There's a lot of evolution, there's a lot of growth. Now things have become more transparent in the financial industry. Technology has become more advanced, and regulations have added safeguards. But what else has grown and evolved since 2008? Well, since 2008, which is around 15 plus years ago, the mutual fund industry has grown 3 times. That is from 20 trillion to around $60 trillion today. But what else has grown? 10 times. That is how much the global e-commerce industry has grown. So think about your Shopee, Lazada, Taobao. When you're rushing to add coupon, add to cart, to check out on like 7/7 sale and so on, that is how much the global e-commerce industry has grown. That is something that we are all so used to in our everyday lives. So when you think about something that has grown 20 times, that must be something that's huge, something that's very prevalent, and something that you must have seen. And that is how much the ETF industry has grown since 2008, 20 times. But the ETFs weren't created in 2008. ETFs were created in 1992. But since 2008, the ETF industry has grown tremendously. It has now grown to the $15 trillion industry that it is today. And we think that in the next 5 years, the industry will grow to $30 trillion. And that's because the ETF industry has typically doubled every 5 years or so. But why is it that since the global financial crisis, ETFs have grown so tremendously to that $15 trillion today? What has changed? What has evolved? What has grown? Well, I believe it's mainly 3 reasons. Transparency. Post-global financial crisis, investors like yourself and myself really wanted transparency. That is about wanting to know what you invest in, what you're holding, and more importantly, what you are not investing into. The second reason is liquidity. And that is the access to investments, the ability to get into investments, but more importantly, getting out of investments when you need to, when you want to. And last but not least, cost. All investors care about cost. And it's most important to know what you're investing, how much it costs, and to not pay into any unnecessary fees. So when you think about all these three features of transparency, liquidity, and cost, are they features of a specific asset class? No, not really. Are they features of a specific investment strategy? Also no. Are they features of a specific investment manager that's managing your money? Also no. These three features of transparency, liquidity, and cost are all features of an ETF. So an ETF provides you the ability of transparency, liquidity, and cost. But similar to technology, transparency, and regulations, ETFs as a whole has evolved as well. So we first started out with ETFs seeing it as a passive strategy, following the index. If you want to access to the 500 stocks in the S&P, you access it through a passive ETF vehicle. And then it's gradually evolved to maybe smart beta strategies. What that means is that you could invest into single factor strategies, such as quality, value, or momentum. And this is where we are at today, where now ETFs has evolved to be able to tap into active ETF strategies. So today I'm here to talk about active ETFs. But what is an active ETF? So there's two parts to it. Active. Active management, as the name suggests, is allowing you to tap on the insights and research capabilities that you and I may not have at home, but as an investment manager who spends their full time looking at insights, finding the best research, finding the best securities for your investment portfolio, and that is the active management component. And in JPMorgan, we pride ourselves in that. We employ 1,000 investment professionals across the globe, be it in Mexico, US, Japan, Europe, or even in Southeast Asia, to look at these investment securities and to select the investments that we like and exclude the investments that we don't like. Now, when you think about that ETF structure as well with transparency, liquidity, and cost, these two structures have been extremely successful on its own. Active management has been around for many years, and ETFs, like I mentioned, has been around since 1992, and they thrive on their own. But right now, with active ETFs, you are essentially combining two of the best structures into an active ETF format, like one provided by JPMorgan, like one available on the FSM platform. And when we look at the growth of active ETF itself, active ETFs is growing faster than any other type of ETFs out there. So it's today a $1 trillion industry, but we believe that in the next 5 years, will grow to $6 trillion. And that's because the active ETF industry doubles typically every 2 to 3 years. And the reasons that we think have brought ETFs to where it is today, a $15 trillion industry, which is that transparency, liquidity, and cost, are the same reasons that will drive active ETFs forward. And that is, like I mentioned, transparency. With active ETFs now, you don't have to wait for holdings to be reviewed once a month. You are able to view your daily holdings every day, knowing what the investment manager holds, as well as knowing what the investment manager is not holding. It is about taking ownership of your own portfolio. Liquidity. It's about access of the same quality of investments as the large financial institutions through just your mobile phone, through a brokerage, and the access to be in and out as and when you want it, or at just one ETF share, or maybe just $50 US. There isn't high minimums. And obviously, the last component, cost, which is what all investors care about, is what I care about as well. And at JP Morgan, we do care a lot about costs. When you look at the average fee of an active ETF strategy, it's around 57 basis points or around 0.57%. When you look at a JP Morgan active ETF strategy, that's around 36 basis points or 0.36%. Now that is 20 basis points of management fee that is safe, and that's in your pocket, and that's not paid for unnecessary management. And the reason we can do so is because we have been managing these strategies for many years. We have already had all these investment professionals, all these insights, all these research capabilities already within our JP Morgan network. Now all we have done is to bring it into an ETF format, bring it accessible to you. So I also want to talk about how investors are using ETFs today, active ETFs today. Now, there are many different types of active ETFs. Firstly, you have active ETFs that are just a step out of passive allocation. When you think about your passive market index exposure these days, sure, when you invest into a passive ETF, you might access 500 stocks within the index. But these days, the index itself is still quite concentrated. Being diversified in a passive investment may not necessarily be fully diversified. Now, with such research-enhanced index strategies, what you do is you kind of take a step out of passive, where you keep your tracking error low, you keep your beta low, you regionally, sectorally, you kind of look and feel very similar to the market index. But what is different is that an active manager can take that small weighted bets on individual stocks, overweighting the stocks that we like, and underweighting or excluding the stocks that we don't like. Another way that investors are using active ETFs is a cash plus product. It's a step out of money market funds where cash may not be giving you that yield that you're looking for today. And so you can take a step out, allocate your excess cash into something that offers you higher yield, but a lower duration risk. And last but not least, an outcome-oriented solutions. So what that means is that if you may have an investment objective, if you may want to generate income, you may want to invest into something that serves your retirement years, active ETFs offer that strategy through an income-oriented approach. What this does is that it allows you to still stay invested into the equities market, but maybe you don't want to have that level of volatility exposure. You're afraid of where uncertainty and where the market is going. Such strategies offer you that income handle, but also a lower beta, lower volatility portfolio. Now you're gonna say, Jordan, there are so many strategies, so many different types of active ETFs. It sounds good. Everything here so far sounds good. So what's the catch? Now the catch is that similar like investing into an active unit trust, the same things apply to an active ETF. And that is choosing the right investment manager to fit your investment goals. Now at JP Morgan, like I mentioned, we pride ourselves in being a core active manager. What that means is that in the MSCI world, there's around 1,500 stocks. Our investment professionals look at more than 2,500 stocks, investing into the securities that we like, and similarly excluding the ones that we don't like. And when we look at the percentage of our funds assets that outperform the peer median on a 10-year basis, in 2013, all of our active strategies, 80% of the active strategies outperformed the peer median. In 2014, 82% of our funds assets outperformed the peer median. And in 2015, 2016, 2017, and so on. Now, I did say that consistency and calm. The year has been anything but consistent and calm, but over here is our consistent performance. Over a 10-year period, more than 80% of our fund's assets have outperformed the peer median. And that's because of investing into our research capabilities, our insights, and our investment professionals. Now, the concept of ETFs isn't new, and there are many active ETFs around these days. But how we build our active ETF strategy, it's a bit different. How we build our ETF business is a bit different from other managers out there. When you look at other managers, you might have your liquidity team, your fixed income investment desk, your equities desk, and even your multi-asset desk. With ETFs, they tend to build it beside all of their investment teams, where there is an independent arm away from their fixed income desk, away from their equities desk. They are building out a whole new capability on its own. Over at JP Morgan, how we build our ETF team is a bit different. We'll build it across our investment desks. What that means is that we are tapping on the investment strategies that we already exist, that we have already provided to large financial institutions, but now we are offering it in an ETF format that's accessible to you and I. Now, when you think about all these strategies, they aren't new. Large financial institutions have been using it for years. High net worth, sophisticated investors have already accessed all these strategies. But what is different is that you can now access it through your mobile phone, just one share. And with that, and combining it with us as an active core manager, the results of our active ETF business is that on a 3-year basis, 97% of our equities active ETFs outperform the peer median. 96% of our fixed income active ETFs outperform the peer median. And on a longer period of 5 years, it's also 90%. And that's where the consistency comes in. And the reason I say that is because we pride ourselves as the active manager. We pride ourselves as the active ETF manager. We want to be at the forefront of active ETFs. We are committed and we believe in it. And that's the result of that is that we are very fortunate to become the manager of the largest active equity ETF in the world. Now that's the income-paying one. The manager of the largest active fixed income ETF in the world. That's the cash plus one. And the manager of the largest active ETF available in Europe. Now that's the one that stepped out of passive as a research-enhanced strategy. Consistent and calm. The year has been anything but consistent and calm. But what's most important is that for you to stay invested, staying aligned with your investment goals, and active ETFs as a tool can help you meet those goals, all while enjoying the benefits of transparency, liquidity, and cost. Thank you.